Blowout. That's the word Wall Street insiders used to describe the May jobs report. The economy created 390,000 new jobs last month, and this is on top of the 430,000 made the month before. But Wall Street still isn't happy as stocks crashed yet again. So why is good news now considered bad news? Hi, everyone. I'm Veronica Dudo, and welcome to Buy, Hold, Sell. To answer that question, let's bring in the traders, Todd, Schoenberger, Tobin Smith, and Jordan Kimmel. All right, Toby, great news on the economy should not result in a market crash. So why now? What's going on?
Yeah, well, let's never, confuse the real world, the real economy with the stock market and the financial world, number one. Number two, it's been 12 years since we actually had any interest rate hiking, so on and so forth. And they're doing that obviously because of this runaway inflation that's not going anywhere, by the way. So in that case, when you get a jobs report that says that the economy is still ticking at a high level, excuse me, that also means that inflation is ticking at a high level. That means that interest rates aren't high enough. And when the real economy is out kicking the stock market economy, the Fed raises rates. And when the Fed raises rates, that puts stock values down. So that's why, quote unquote, good news in the real world is bad news in the stock market. And frankly, Veronica, as you get into it, that's the last number before we sort of roll over. And then, let's not forget that we're at a 2-year pandemic and there's, a lot of weird stuff going on that makes that happen. But that's why good news is bad news, because it means the Fed needs to be more aggressive.
I got to tell you, though, we heard from the White House today. It sounded like everything was great. I mean, we're hearing about wonderful numbers from the White House. I mean, just in April, we had 40,000 new jobs, 390,000 in May. Yeah, a little bit of a dip, but still, that's very solid when you start thinking about it, Toby. I'm not sure. When I think of Middle America right now and they open up their newspapers tomorrow and they see that headline, they're going to be feeling pretty good. And then they're going to start scratching their heads wondering, why did the stock market go down?
Jordan, what do you think about
because
the report?
They didn't watch this show. They should have watched this show. They'd understand it. I'm sorry.
Well, look, the problem isn't the jobs, and more people working. That's a great thing for the country. The reality is that inflation is the monster in the room right now. And there's a lot of people who just dumbly think that the Fed is going to be here to bail out the speculators who bought the high price to sales, the SPACs, the NFTs, what have you. The fact is the Fed has already said we're going to continue to raise rates. That's the problem for the stock market. And that problem doesn't go away today. It's a great thing more people are working. It's a great thing they're getting paid a little more. The problem comes to the fact that there's no more zero interest rates and that the denominator starts to change with PE.
But you remember years ago, though, Jordan, I mean, the stock market was always going to move on the jobs report. And now it seems to be irrelevant. I mean, now we can actually say, hey, this isn't really that big of a deal. We'll talk about it, but it's not going to move the needle because what is moving the needle is what's coming out of the Federal Reserve.
Yeah, but Todd, years ago you had more hair, okay? It's a different time. I mean,
all right,
it's not relevant.
So we know
it's not relevant.
The Fed is saying
it is not relevant.
One more thing. When you talk about relevant, non-relevant, remember it's still called the non-farms payroll. Who the heck's working in a farm anymore? And the fact is these numbers don't make any sense to begin with because more of the economy is working for companies with less than 50 employees. So these non-farm payroll numbers, and I can't believe they haven't changed the name yet, is a little bit less relevant.
So we do know, as you guys have mentioned, that the Fed is going to stay the course. They're raising the 50 basis points, what they had said. But now we're also hearing that some of the tech sector, Tesla, also Coinbase and Microsoft, they're laying people off. Toby, what do you make of this?
Well, it's real simple. And if you're around as long as I have been, and maybe Jordan, we had this IPO bubble. And in the IPO bubble, everybody, hired everybody. The thing crashed, and then everybody got laid off. we've had the same thing go on remember, we have something like 380 private tech companies that are valued at more than $1 billion. And just last week, SoftBank, which is one of the investors, wrote down some of those values by 80%. So there's a crash within a crash within a crash right now. And right now, that big crash is in all those private companies that absorbed, my favorite number, $2.1 trillion of venture capital, go build the next Facebook type of money. And now the caca has hit the fan. That's a very big economic term.
Yes, it is.
And now we have to, it's becoming unwound. The good news is there's still 2 jobs available for every 1 employee. And in the tech world, some of those guys may be driving UPS trucks pretty soon.
Yeah, well, you know what? Let's start digging deep into the jobs report. I mean, one thing that we saw, the number one gainer for the sectors was leisure and hospitality. Saw 84,000 new jobs, but it's still 1.3 million below that pre-pandemic level. Then you start looking at jobs that were lost. I mean, retail jobs, hourly wage jobs, minus 60,000. That really shows you, that gives us a clue that the American consumer is not going to be spending, and therefore demand is light. So you're probably going to see that number further erode down the line. But even in leisure and hospitality, that's not exactly a high wage earning job. So now you start looking what's in the middle. And, Toby, you brought it up best earlier about the tech sector. We saw the tech sector actually did not grow at a rate that we were expecting. Veronica brought up a number of tech companies that were experiencing layoffs. The future is very bleak right now. So I can understand the stock market reacting the way it is because the forward guidance just doesn't look good.
So, Jordan, we do have that report that's out. So it's a new month. Will we see new volatility for the markets?
Well, we're just seeing a ratchet down, if you will. We're 1 step forward, 2 steps back. And while we would love to be a cheerleader for the market, sometimes you want to be realistic and see the market wants to let out some air. And so, I don't see the market actually hitting new highs for a while. I see us ratcheting down, in fact. And so whatever statistic comes out, what you're seeing is people pulling money away from the market, people just not feeling comfortable in the market. I'll say it's a bifurcated market. We'll get into this later, where there's a lot of cheaper companies, particularly the software companies, though, that you were mentioning. There was free money going around. They didn't care about earnings. They were looking at different metrics again. Tobin mentioned it's very similar to the 99.com era. Well, there's no more free money right now. And now these companies are starting to say, we can't just keep bringing on more and more high-paid engineers while we're bleeding, because the access to the capital is really not there at the same level anymore.
Yeah. All right. Well, great conversation, gentlemen. A few Wall Street heavyweights warned this week that tough times are ahead, but are their fears overblown? We'll discuss after the break.
Hey friends, investor friends, this is Tobin Smith. I just show this if you may remember me from my 25 years on business TV, but it's not about me, brothers and sisters. It is about this. We are about 5 times the average, stock average, over the last 2 years, but more importantly, this year, we're up about 67% in our portfolios, while the S&P is down, 12% and going deeper. And the Nasdaq's down 25% and going deeper. Let me ask you this, are you tired of losing money? Because right now, we forecast not only a big recession in 2023, but we think we can do this again. We think it could be up again another 50 to 60% by being in the right place, the right stocks, and at the right time. That's what we're doing right now. So join us, transformativeresearch.com. Get on our free newsletter, transformativeresearch.com. Join us for free and stop losing money.
Hi, everyone. I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians or Europe is going to say, hell no.
If Russia doing things logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
Welcome back. JP Morgan's Jamie Dimon and Goldman Sachs' John Waldron are painting a pessimistic future amid a string of shocks rattling the global economy. Both men feel inflation with changing monetary policy and the Ukraine-Russian war are going to kneecap growth prospects for the foreseeable future. Toby, are they right?
Well, I wish I had better news. And excuse me. What is confused all of them, and Jamie Dimon actually sees it locked me up. Jamie Dimon, he sees the money going in and out of Chase, JP Morgan Chase, right? So he has somewhat of a feel that way. On the Goldman Sachs side, he's an international guy, and he sees internationally. What we don't realize in the United States is you think inflation is bad here. You should be in Europe. You should be in Italy. Oh, my golly. They are slave to energy.
Come on.
Russian energy. So,
we don't care about what's going on over there.
Well, yeah, but remember, all of the market cap of our stock market, Toddo, is in 10 companies that are global companies. And so when they look out at the globe, I know, Buffalo, New York is really your center of focus in life. But
oh, God, no.
But the rest of the world is not responding well to this energy crisis and the food crisis and the fertilizer crisis, and everybody's raising rates at the same time.
Right.
In Ukraine, the prime rate is 25%.
Yeah.
In some of the European countries, it's 12%. So if you expand your horizon, there is a reason why they are so shook up.
Well, I got to tell you, though, I am very concerned that you have leaders of major bulge bracket banks that are this pessimistic. I mean, this is unheard of in corporate America. CEOs are always known to paint this rosy picture. Things are great, yada, yada, yada. Even the President of the United States will come out, like in his presser today, or talking about the jobs report of how great everything is. Oh, we're doing this and doing that. And things are wonderful. I mean, you rarely have leaders that say how pessimistic things are going to be. But here's the big concern.
What does that mean, Todd?
Hold on. Here's what I think
mean?
it means. Here's what it means. When you have his bankers, like Goldman bankers or JP Morgan bankers, they're going out, they have their dinners. Toby, Jordan, I'm sure you guys have been involved in these dinners. You guys know that people are talking, and this is really inside Wall Street stuff. If they are pessimistic at the top, imagine what the talk is like at the bottom. And therefore, you're going to have a real revolt. You're not going to have as many M&A deals that are taking place. You're going to have a lot less IPO offerings. So you have a number of issues right now that could be a bottleneck. And I think when I hear from those guys being that pessimistic, the future is just as dismal as it's ever been.
So Jordan, we hear a lot of times it's business, it's not personal, try to, check the emotions at the door. But when you're listening to these statements by Jamie Dimon, he was very emotional talking about a hurricane coming. I mean, how do you see this?
Right. Well, he also reversed the course from the week before. We saw that everything was calm, but he's now going to be known as Hurricane Jamie, and frankly, he has he's been honest about where things are. But I want to put things in perspective here right now. I didn't get hit by a piece of sky, even in the worst of the markets. So what we have here is what's called a bear market, and it's called the recession. And the thing is, these are cycles, and anyone who thought the business cycle was cured had their head in the wrong place. So the whole key is.
Jordan, are you trying to tell me there's no such thing? I mean, I thought markets always went up. There's no such thing as a down market, right? I mean, isn't that what all the investors keep telling us?
Here's what someone said to me the other day, that I said, look, the market is in these 10-year cycles where it had these very high double digits for the last several years. The next couple of years will look nothing like it. So they said, oh, you mean we'll only get 8-9%? And I'm like, no, that's even above historical rates. How about -8? How about things equaling out? So the point is, bear markets aren't terrible. Recessions aren't terrible if you plan around them and work around them. And frankly, at the bottom of the recession, as we know, is a great time to build. It's a great time to buy. You just don't want to buy as the storm is starting to come. You need to wait till the storm kind of exhausted a lot of its pressure already.
I'm getting a side hustle. I'm going to work for Tobin Smith, Inc.
So, Toby, do you think the markets have become complacent with inflation?
No, I mean, we were complacent because, I mean, part of the thing about the last 12 years, but, you know, other than the last 3 months, we also had 2% or lower inflation. We've never had a situation where the Fed, you know, pumped in ultimately $6 trillion of cash money into the monetary system, so that had to go somewhere. And we had below 2% inflation because, shock of shocks, when we outsourced all our manufacturing and we got Amazon and we got somebody to deliver stuff for 50% less from Walmart, all our cost of living went down. It's called the Great Moderation, right? So in that situation, we've heard, and I've talked this story a lot, about how essentially, remember, we had the great pull forward of demand for like Zoom.com and the great pull forward for it. Well, we had the great pull forward of equity stock returns. We pulled forward 25 years of returns into 8 to 9 years, because at 17% returns for 10 years when we used to have a 7% rate of return. And now we've pulled forward everything we can. By mathematics, by financial gravity, we got to give some back. And that's to Jordan's point. The person says, oh, we're only going to make 8%. Dude, you only made 7% a year in 40 years. So it's got to pull back.
Let me bring something out here. Not only, I mean, you talked globally a few minutes ago. It's really important. There was no playbook ever written when interest rates were negative. So we had trillions of dollars at negative interest rates throughout Europe. And people were saying that at 0.02, our rates were high. So there was clearly some sort of funny house mirrors going on. But when you talk to economists, there is no playbook coming out of negative interest rates. It was a weird time, and it was a funhouse time. But I've said before, if you didn't hear the music getting louder, if you didn't see the chairs being taken away several months ago, then you haven't been around markets for a very long time.
So, Todd, this week we saw Treasury Secretary Janet Yellen come out. She said she got it wrong when she was the Fed chairwoman.
Wow.
You know, we also heard the press secretary for the White House say, we don't watch the stock market every day, when she was asked that question. So, I mean, what do you think the market is taking from this with the administration moving forward? You know, what are investors thinking?
Yeah, who's running the show? That's what everybody on Wall Street wants to know. And you know the traders are asking that question. Look, when the White House comes out and says, yeah, we're not watching everything every day, guess what? You know, you have to think about how people vote, and they vote with their wallets. And that might be something that the Democrats might want to start focusing on. But realistically, going forward now, you have so many headwinds that are taking place. You have higher gas prices. Food costs are skyrocketing. You obviously have a depreciating stock market. We have so many issues right now, and the only good thing that can come out of any of this is that you have a jobs report that's pumping out almost 400,000 new jobs. That's the only sign that's positive. So where do we go if we lose that and we start losing jobs? Say those jobs numbers start declining rapidly, which could happen, and a lot of Wall Street analysts are predicting that. You're going to have it's just going to be hell, because then people are just going to lose it. And now you're really going to have problems in the United States.
All right, we have to leave it there. Thanks, guys. It's not all doom and gloom on Wall Street. We have one stock that continues to crush its quarterly earnings. So which one is it? Stay with us after the break to find out. Buy, Hold, Sell Live, brought to you by Transformity Research.
Hey friends, investor friends, this is Tobin Smith. I just show this if you may remember me from my 25 years on business TV, but it's not about me, brothers and sisters. It is about this. We are about 5 times the average, stock average, over the last 2 years, but more importantly, this year, we're up about 67% in our portfolios, while the S&P is down, 12% and going deeper. And the Nasdaq's down 25% and going deeper. Let me ask you this. Are you tired of losing money? Because right now, we forecast not only a big recession in 2023, but we think we can do this again. We think it could be up again another 50 to 60% by being in the right place, the right stocks, and at the right time. That's what we're doing right now. So join us, transformativeresearch.com. Get on our free newsletter, transformativeresearch.com. Join us for free and stop losing money.
If you like Buy, Hold, Sell Live, be sure to smash the like button.
Lights, cameras, connectivity to every kind of screen, with 6 broadcast studios and experts ready to help plan the event. Big Wig Media's broadcast center at the Willard is the ideal headquarters to host your virtual meetings and video conferences. Let's get started.
Thank you for joining us. To date, 87% of S&P 500 companies have reported earnings, and nearly all of them are providing dismal guidance for the immediate future. One, however, continues to deliver good news. Lululemon reported earnings this week, and the company posted better than expected numbers for earnings and revenue. Todd, what is Lululemon's secret?
Yeah, great question, because right now they're not just catering to the female demographic, they're also catering to the male demographic. They have a number of new products that are coming out. But what's unique about this stock is that over the last 8 quarters of their earnings release, they've seen the stock gyrate almost 6%. There's a lot of volatility, a lot of options trading that's taking place with this stock. Not quite sure why it's this one particular, but maybe it has the lighter volumes to do with it. But the stock's trading at $300 a share right now. It's got a wonderful track record, but what's really cool about this company is that their forward guidance is just magical. It's very bullish. They're expecting not just seeing double-digit growth earnings from the earnings side and also the profit side, but they're expecting to expand globally at a rate that companies would just cut off their arm for. So going forward, that's what investors, if you're looking for a bullish side right now or something to invest in, that's the area to look at.
They definitely have an international audience. Toby, are you bullish on Lululemon?
Well, I am for a couple of reasons, but here's the caution first off. Number one, they've converted their business model from, forget about the stores, 75% of their sales are direct to consumer,
right,
which means that guess what? They are getting a much higher margin. That's fantastic. The hard part of this is that it's a brand that's known in North America. And as soon as you go out to other parts of the country, or the world, I should say, building a brand is very expensive. It takes a lot of time, and this is a high-end brand. High-end brands typically are known to the higher-end customer around the world, and maybe that's what's going to help them. But I will tell you, they have a new line of golf shirts and golf pants.
Yep.
And oh my gosh, you put the golf pants on, and you know, even an old dude like man, I'm looking pretty good in that freaking stuff. I'm telling you. So, I think they are a good chance to make it. And at the high end, we don't have any problem with discretionary spending.
So they definitely added menswear. They also have the mirror where you can work out, the electronic reflection. And they really are trying to put together outfits that you can take from working out to the office. It's something that you're seeing, getting a lot of traction also in Europe. So Jordan, it's really hard to see these COVID winners and then, coming out of the pandemic, a re-winner. Do you think with launching some additional products, that's kind of what set them apart?
Well, you know what? Lululemon's a great brand. It's an aspirational brand is what I call it. Everyone wants to own a piece. If many people can't afford it, but if you were going to get a gift, man, everyone would like that as a gift. The problem I have with it is a couple. Number one, I found it early and didn't stick with it. The other problem is it's very expensive. And the third problem is, unlike Tobin, I don't know. I still aspire to look good in that stuff. So, I think it's just really expensive. It's a great brand. And it's the kind of company that you want to try to find, on some sort of earnings disappointment when it comes in for you. But really quality, high quality. They're hard to buy cheap. I give them a ton of credit, and I smack myself every once in a while for not sticking with it when I first found this thing maybe 10 years ago.
Yeah, but this is one of those companies, though, right now, Jordan, that they are a brand right now. Toby said it best here in North America. They are expanding, but they are showing that growth. One thing about a lot of companies, especially when it comes to the clothing side, they get stuck in their ways. They just stay within that one model. Here, Lululemon is actually thinking out of the box. They're going after that male demographic. I mean, think about who controls the finances in the household. It's always going to be the woman. She's going to spend money for little Johnny for school, maybe save, she'll spend for herself and maybe a couple bucks for the husband if there's anything left. But they're always going to look, and they're going to buy items that are there, and they're going to stick to those brands. And now you have another part of the American family household that's actually going to be able to wear this stuff. I see a big growth story here. I think this is something that they really should be much more proactive in marketing, because especially in a world right now where there's so much uncertainty, they seem to have it right.
Toby, do you think their growth is sustainable?
Yeah, well, again, two things. There's sustainable growth, and then there's sustainable margins. And what makes Lululemon unique is that when I bought the $195 pants, they probably have about $15 of product cost in there to actually make them. And, of course, they're made in Vietnam, right? So, they would do better if I buy it from them directly than me from my golf shop, which I bought at the golf shop. And so if they're going to expand, what makes them magic is that because of that 75% direct consumer, they're getting top-line growth and they're getting margin expansion. That's very unique. Now, the question is how long, and I am not an expert in clothing. I'm an expert. I'm wearing an Armani jacket that I bought 20 years ago, okay? So but I believe in... Yeah, I believe in buying sports. High quality, right? And then beyond that, clothes go in and out of fashion. I will tell you though, if you ever go into a Trader Joe's about 9:30 in the morning, half of the women are in there in their Lululemons, and it's a lot of fun to go shop at that time.
Well, fantastic insight, gentlemen. Have you purchased your electric vehicle yet? If not, there's one American company that thinks you will, and they are betting it's not going to be a Tesla. Which car company are we talking about? Stay right here to find out. Buy, hold, sell, brought to you by Crosscheck Management. Hi everyone, I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
Financial News TV, just the way you like it. Fast-paced, unadulterated, in-your-face, rock and roll style. Join us next time on Buy, Hold, Sell Live.
Oh, yeah, I'm going to remember all that. I can't even remember. Oh, God. Yeah, well, that does. I want you to, oh, my God. Fast-paced, no, oh, sorry.
Take one.
Fast-paced, no holds barred, in-your-face, rock and roll style.
Woohoo! Let's kick some ass.
I want you to smash that like button.
Track, cue, dissolve.
Good morning and welcome
from Bigwig Studios. From the Bigwig Media Studio.
Bigwig Media's broadcast center at the Willard is the ideal headquarters to host your virtual meetings and video conferences.
Kudos to our team who's running around behind the cameras.
What I liked about working with Bigwig Media was you guys are the experts.
Our industry pros have you covered. Let's get started.
Welcome back. This week, Ford announced a major hiring campaign to bring on 6,000 people to help build its electric F-150 and revamped Mustang. Jordan, since Tesla has a dominant share in the EV market, which stock is better?
Well, you know what, Veronica, I have to say, knowing this segment might have been coming up, I did some homework and I use a magnet model. And unfortunately, I wouldn't buy either one of them right now. But, using the magnet model, there's a company called Visteron VC, which is actually a Ford spinoff. And what they do is they make the dashboards and the control panels, the climate control, that they sell to everybody, including Ford, including GM, including VW, and so on. And so this is one of the examples of, instead of buying the gold mine that you hope will find gold, it's buying the Levi jeans that everyone's going to wear where they're looking for gold. So the best, highest ranked stock in the magnet stock selection process in the auto and in the autonomous area is VC. And I even have to say that I did my homework today. Knowing us coming on the show, I'll wait to buy the stock on Monday and share it with the audience first.
All right. So, Todd, they also talked about exclusively selling online. What do you think of this?
Yeah, well, that seems to be the trend, right? I mean, with companies like Carvana, they're doing the same thing. I'll go out with this one. I mean, with Ford and Tesla, look, I love Ford. I love Tesla. I think Elon Musk is a genius. And but when I start looking at companies, I look for their growth prospects. They already have the Mustang. We all know that a revamped Mustang, it doesn't have to be revamped. It's still going to sell. But this F-150, to have an EV F-150 is truly a category killer. It's something very unique. And you can see what they're doing because they're competing against Tesla's upcoming pickup truck. But if I had to pick the two companies, I got to go with Ford right now. I mean, I love that growth story. I love the fact they want to hire 6,000 new workers. They're actually going to bring on 3,000 other temporary workers that could eventually move into and convert into full-time union jobs, which is also great. So they have a dividend yield right now of 2.9%. Tesla doesn't offer a dividend. I'm really big on companies that offer the dividend. I'd say I'd buy Ford right now.
Toby?
Well, jeepers. we were short Tesla. Again, I love the car, love my Tesla. Didn't love the valuation, right? Secondarily, Ford, the F-150s, I love the fact that, I mean, what is it, Todd? 150,000 are already reserved.
Yep.
And it is not a cheap vehicle starting at about $56,000.
Yeah.
That means Todd will have 5 of them. But I actually am more impressed with a company in China, NIO, N-I-O, that because of the reopening in China, they had a significant amount of their sales sort of mothballed. In China, you have a tax credit that on a relative basis is higher than we have in the United States. And its sales growth, they're profitable. But what they've done is they've taken the Tesla idea of having charging stations all over around just for Teslas, by the way. On the NIO, you have 55,000 charging stations just in Shanghai, Beijing, Zhangdang, the big areas. And you can also have a little gas tank. And that little gas tank allows you to charge your engine. So at the price point, at the utility in China, NIO was a $70 stock. It's down to $20 here. If you take their earnings out over the next 2.5 years, to me that you're buying it at about a 12 price to earnings ratio. I like the growth and I like the price. And China stocks were getting blown up because of all various issues. Now they're reopening and they're cutting down the rhetoric. So that's the one I'm buying.
So, Jordan, we also had seen a company in China, and they were making some of the electric vehicles for $8,000, and obviously a lot of movement in that direction. Do you ever think that the area would be oversaturated?
Well, I don't think the EV market's going to be oversaturated. Unlike Tobin, I don't really trust the numbers over in China. I don't trust the financials in China. And I think there's going to be just more and more issues over there. So, I've been there. I'm sure Tobin's been there more than I have. They don't really care about numbers so much. They care about other things. And so, I'd like to keep the money here in America. I don't mean to be over flag waving. And, as far as Ford goes, we were long Ford. We had to sell it because, again, I follow a model. The numbers changed, the relative strength changed. And I just hope that the Ford 150 doesn't have these recalls that you keep seeing in the paper, with Ford. So I'm rooting for Ford real hard. I happen to love Elon Musk. I think he's a hero. But again, I use a model, and we wouldn't touch it based on valuation.
The biggest issue with these electric vehicles, though, is that you have to charge them, and you usually have to drive a few miles off the interstate to recharge them. And what do you do for a couple of hours? That's the only thing. I mean, they really need to have these charging stations in convenient spots. Maybe, I don't know, where gas stations are would actually help. But they have to figure out, and this will evolve, this will happen over time, the ability to actually charge fast. And
Todd,
once that happens, then we'll be a different
the business
spot.
model, the audience for them right now are not people like you driving 800 miles to go do a TV show. The model is people who drive like normal human beings,
right?
Which means that they drive about 18 miles a day is the average, and so that's who they're selling to, for crying out loud.
All right,
so true.
Nothing like taking your experience and extrapolating it to the entire world. I love that.
Terrific conversation, guys. Earlier in the show, we talked about some Wall Street leaders warning us about dark clouds and potential financial hurricanes. If this sad forecast holds true historically, there seems to be one sector that unfortunately might benefit. Which one is it? Stay tuned to find out.
Hey friends, investor friends, this is Tobin Smith. I just show this if you may remember me from my 25 years on business TV, but it's not about me, brothers and sisters. It is about this. We are about 5 times the average, stock average, over the last 2 years. But more importantly, this year, we're up about 67% in our portfolios, while the S&P is down, 12% and going deeper. And the NASDAQ's down 25% and going deeper. Let me ask you this. Are you tired of losing money? Because right now, we forecast not only a big recession in 2023, but we think we can do this again. We think it could be up again another 50 to 60% by being in the right place, the right stocks, and at the right time. That's what we're doing right now. So join us, transformativeresearch.com. Get on our free newsletter, transformativeresearch.com. Join us for free and stop losing money.
Hi everyone, I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
History has shown us that during recessionary periods, alcohol consumption rises as many people try to cope with the stress of troubling personal finances. Toby, with so many Wall Street economists predicting an inevitable recession, is now the time for investors to consider adding these stocks to their portfolios?
Well, I always like to say that it appears that people have sort of forgotten that we've been in a freaking pandemic for 2.5 years, and alcohol consumption skyrocketed.
True.
So again, my sort of point is that first off, in our house, if alcohol consumption is considered to be recessionary, then we've been in a recession for like 22 years. Okay, but if you look at the the upside, this is another pull forward product. I mean, look at the seltzer things. Well, it was all the rage, right? And then everybody's had seltzer. Now it's over. So again, all those rules of thumb have gone out the window. And if you're investing based on rules of thumb from the 18th century, it ain't going to work.
So, Jordan, do you think alcohol stocks are recessionary resistant as opposed to recessionary proof?
Well, they're recessionary enhancers. I don't know what they are. The fact is, there's not enough of them. None of them score high. Maybe you want to look in the sleep disorder area, in better mattresses to get better night's sleeps. But, I think Toby hit it on the head. I think that the alcohol consumption has been pretty strong for the last couple of years. And I don't know what's going to make it increase from here. So let's just hope that doesn't happen and find some other, areas to look at.
So, Todd, we saw a lot of the stimulus money going towards places like Home Depot, Lowe's. People were doing at-home projects. And as Toby did mention, they sort of, have enjoyed being at home during the pandemic. Do you think that this will just continue on in terms of looking at any type of alcohol stocks?
Well, you're right about the DIY stocks. Absolutely. We saw a big pop in all of those during the pandemic. But what economists are looking at is trying to predict the future by looking at historical numbers. So during the Great Recession, we actually saw alcohol consumption increase close to 30% nationwide. I mean, it's just awful. So the feeling is that if we have a prolonged recession, you will have an increase in alcohol consumption. And therefore, that does lead to obviously social issues, disease issues. As Wall Streeters, we do look at the opportunity as well. So when you start thinking about maybe some particular stocks like Brown-Forman, Jack Daniel's company, that's where Brown-Forman will be a big winner. But on the beer side, I would probably stay away from companies like Molson Coors, only because so many people have been migrating to IPAs. They're getting away from, say, drinking Coors Lights. I know personally that's what I do. So you have to start thinking, are any of those companies public? And I don't think there are any right now.
Well, Constellation Brands is if I was going to buy one, is the one that I would buy, simply because they're so diversified and they're so international. They also make a nice profit. They pay a little dividend, but you're not going to get rich buying liquor, companies at their low growth rates, because at the end of the day, what the business model is somebody starts. I have a friend who started a small bourbon company. We all invested like $5,000, and it became a pretty big one. And then we got like $50,000 back from that because it was bought by Constellation Brands.
Yeah.
Where you make the money is in the new stuff, doing the new categories.
Right.
But these big guys have growth that is cyclical, but not a lot of money to be made here. And the big money has already been made over the last 2 years.
Well, hold on, though. I look at some of these alcohol companies. The margins are actually pretty wide. I mean, they're not bad companies to hold in a portfolio. The question is, though, is that going into a recession, will you see more of a pop? And history has shown us that we will. We will see more of an increase coming from the Constellation Brands of the world right now.
You can't buy any more booze than we bought in the last 28 months.
You can consume more, Toby. Go. I know you're up for the challenge. I know you are.
I was so upset with the Warriors losing in the last 3 minutes of the NBA last night. I had to go out and buy booze to deliver to my freaking neighbor who I had a bet with, for crying out loud. All right, but it's Bullet Rye is my friend, but they're owned by the Constellation Brands, and I don't like them. I mean, again, I think any analog, any model that says I'm going to take what happened in the last 5 years, 10 years, 15 years, and then apply that to this, human behavior doesn't change. There's no question about that. But the part that's changed here is that we're actually buying less booze because we bought so much booze, and I'm going to extrapolate my experience like Todd over everybody else and say that, at some point in time, your liver, gives you a wake-up call.
Oh, my goodness.
And maybe people are buying Lululemon to work out, and they want to be healthy, as we just talked about.
No.
There you go.
Nice tie together. There you go.
Toby goes for runs. He just runs to the liquor store.
Combining everything. All right. Great discussion, gentlemen. Coming up next, it's time to make some money. Buy, Hold, Sell Live, brought to you by Transformity Research.
Hey friends, investor friends, this is Tobin Smith. I just show this if you may remember me from my 25 years on business TV, but it's not about me, brothers and sisters. It is about this. We are about 5 times the average stock average over the last 2 years, but more importantly, this year, we're up about 67% in our portfolios, while the S&P is down, 12% and going deeper. And the NASDAQ's down 25% and going deeper. Let me ask you this, are you tired of losing money? Because right now, we forecast not only a big recession in 2023, but we think we can do this again. We think it could be up again another 50 to 60% by being in the right place, the right stocks, and at the right time. That's what we're doing right now. So join us, transformativeresearch.com. Get on our free newsletter, transformativeresearch.com. Join us for free and stop losing money.
If you like Buy, Hold, Sell Live, be sure to smash the like button.
Lights, cameras, connectivity to every kind of screen, with 6 broadcast studios and experts ready to help plan the event. Big Wig Media's broadcast center at the Willard is the ideal headquarters to host your virtual meetings and video conferences. Let's get started.
Predictions? Let's make some money. All right, Jordan, what's your summer sizzle?
Well, here's what we have. I think it's a great one, actually. I'm looking for the reemergence of Merger Monday. So while I think the indexes are going to continue to struggle for the summer, I think you're going to wake up on Mondays and find out some good news on a couple companies. And so the biggest companies out there are full of cash. There's plenty of companies in the Russell 2000 that are down not 10%, but 50, 60, 70%. If you actually have a model that could pick out those companies with products and cash flow, the best thing a large company can do is make an accretive acquisition. So I think you're going to start to see at this level, even though the indexes will struggle, that there'll be a couple happy investors every Monday morning when the lawyers got done with their work over the weekend. And I'm looking for the reemergence of Merger Monday.
Toby?
Well, am I going to agree with him or not? No, that was the lamest thing I've ever heard. Yeah, but I want a stock, Jordan. I don't want to, just sit around and laugh at somebody else. Here, it's called buy, hold, sell, right? Here's what you want to buy. I want to buy 9.87% yield from a 2-year Treasury bond with zero risk. If you don't buy this, you are a bonehead. Every one of our accounts, we load it up. You can buy $10,000 a person and then buy one for your wife and your kids. But you cannot beat this deal, number one. Okay, on hold, I want to hold big oils. I got a lot of notes this week saying, geez, should I sell my Exxon or my Shell or my Anadarko Resources? No, you got to hold them. I'm just looking at the futures right now. The futures are pricing in $135 oil starting in July. So I want to own the big multinationals. You can own even British Petroleum with the tax they're adding. And then on sell, I'm selling financials. Financials were supposed to, according to the model, according to what used to work, that when Fed rates go up, they get to do better. Well, they peaked out and now they're going the other way. So I'm out in short financials.
Todd?
I wish I had a newspaper like Toby had. That's an awesome prop. Now, okay, well, back on what Toby was talking about on the hold on big oil, I have to tell you, my buy is going to be ExxonMobil right now. The stock is literally at pennies away from its 52-week high. It's trading at 99 and change. It's got a dividend yield still, even after the run-up, a dividend yield of 3.6%. That's awesome for investors. That's one of those companies you just can't go wrong on. And I know as an investor myself, that's one I would definitely choose to hold on to and buy. On the hold, I got to tell you, this is going to pain me, guys, but the hold I have is Starbucks. If you didn't sell it when I told you to and you're still holding on to it, I would hold on to it only because they just reopened 600 stores in China. That is going to have a significant impact on their bottom line in quarters to come. And oddly enough, the stock as with the broader averages, was down today, but it was on a recent run up. It's in the high 70s right now. I think about 79 and change. Definitely something to consider. You might get a quick 10% run up on that going into the third quarter, which will be good for investors. My sell, I got to tell you, my sell right now is really anything in the consumer discretionary space. Target, Walmart, Kohl's, anything, because when I looked at that jobs report and I saw minus 60,000 jobs, I have to suspect that going forward, that's not good. Those are jobs that are not going to be rolling back. If they do, it will be seasonal, and that won't be until the holiday season. But right now, stay away from them.
Hey, Todd, that's great. I wish we had a time machine so we could go back 4 weeks and you could actually make money off of that. Holy mackerel.
Hey, wait a second. Hey, wait a second. If we have a minute, I can't sit here and take this crap from Tobin here. So I don't want to talk my books. We got a lot of small stocks, mid-cap stocks. I don't want to mention the actual names, but we are long oil. We are long shipping. We are short Shopify. And so the thing is, I just don't like to talk the book on the smaller stocks. It's impolite.
Toby, get your newspaper.
Look at Jordan, buy some freaking 2-year bonds.
Okay, but what happens after 2 weeks of the 9%, Tobin? It goes back to zero?
No.
Tobin.
It's locked in. It's locked in,
for 2
the
weeks?
entire year. Yeah, no, it's locked in for the entire year.
Oh, my goodness.
Yes, it is. It's called a 1-year bond, you bonehead. It's 1 year,
9%, or at 9%, it's not locked in for a year.
Yeah, Maverick.
It is.
Come on.
Dude, it's called a U.S. government treasury bond, for crying out loud.
At 9%.
You buy
at
them,
9%?
Yeah.
Sounds like a little bit too much Brown Foreman over there last night. No 9%, 1% treasury.
The yield is tied to inflation, my friend. And they lock it in for a year.
Still friends, but we're still friends, but I think you're wrong on that
one.
We're
out of control.
All right, time will tell, so we'll have to wait and see. Thanks, guys. Well, that does it for another episode of Buy, Hold, Sell. Remember to follow us on all socials and let us know what you think in the comments section. On behalf of all of us, have a great weekend, and we'll see you next week on Buy, Hold, Sell.